What's up, guys? Welcome to Heresy Financial. Today it is Tuesday, and it is about 1 hour before the market is closing today on Tuesday here. So, just with the volatility in the market, wanted to give you a kind of a brief rundown on what has been happening and provide a little bit of insight for you, maybe on why the market has been selling off the way it has, what people are thinking, what you might want to do in response, some things that you should be thinking about, and kind of a way to kind of tune out the noise and focus on what really matters during this time. So the first thing that I want to do, I have you closer here so we can look at some charts. This is an intraday chart of GLD. That's an ETF that tracks the price of gold. And let me just switch over here to a daily chart. Okay, so here's a daily chart. You can see that over the last few months, it's run up a lot. And yesterday, it hit like a 7-year high. The price of gold itself hit almost $1,700 an ounce for GLD. That was just over $158 per share. Big sell off today. It's down. Currently, it's down about 0.5%. Let's flip over to silver because silver got hit a lot harder. So had a much bigger pop yesterday and a much bigger sell-off today. It is currently down a little over 2%. So right off the bat here, short term, we're seeing a sell-off in gold and silver, and I'll get into why in a minute. Let's flip on over here to the S&P 500. So this is the last couple of months of the S&P 500. You can see that it has been going up, and then the last couple of days, big sell-off, and today we are right now sitting at down about 2.5%. This is the intraday chart. So we bottomed out here. It looks like we might settle out around here, this price level, this 31.45, 31.50 price level throughout the end of the day. Just an hour left in the market. We'll see. Pulling back longer term here, just so you can kind of get an idea. Right about here, this was October. This was really when the Federal Reserve started to ramp up the expansion of their balance sheet here. And so let's pull this back a little bit. That was right about here that they started to ramp up the expansion of their balance sheet. And so we haven't retraced all the area from when that started happening yet. If you've been following the channel at all, you know that has been a big driver in why the market has been going up. Easy money, easy loans, corporations loading up on debt, stock buybacks has been driving the market. And so we haven't erased all those gains yet, but ignore points because everybody's talking about the third largest drop in the Dow in terms of points in a long time. Points are meaningless. Look at percentage. Percentage is what matters. And so the Dow, if we look at the Dow, we are currently sitting right at about the 200-day simple moving average. I don't know if you can see that yellow line there. That is the 200-day simple moving average. So if you're not sure what that means, that's just they take the 200 previous days, average the price together, and every day that they do that, it plots a point on the graph. And so you have a point for every day that is the previous 200 days averaged out together. And so usually that's a line that acts as support and resistance. And if you're above your 200-day moving average, that means over the last 200 days you've been trending up. If you're below your 200-day average, that means over the recent time you've been trending down. And so it's considered bullish if you're above it, bearish if you're below it. We're sitting right there right now at the Dow. And so it kind of looks like the market's trying to determine, are we going to break through that and continue this sell-off? Are we going to stick here and maybe even out for a little while? Who knows? We don't know yet. But what is really interesting here is the Russell 2000. This right here is the Russell 2000. So again, I don't know if you can see it, but we hit that 200-day simple moving average, and we have bounced off of it so far. But I want to pull back here because this chart right here, you can see it. This is the Russell 2000. Contrast that with the S&P 500. The S&P 500 has had this amazing rally, hit all-time highs just a few days ago, hit almost 3,400, and contrast that with the Russell 2000. Well, what is the difference? The Russell 2000 is the small businesses. Those are the ones that have zero to low exposure to any international business. They're all domestic companies for the most part. They're small companies. Um, Trump was supposed to be good for the small business owner, right? He's talking about how great the economy is. If the American economy was so good right now, the Russell 2000 is the one that would have been making all-time highs and growing a lot and making these record high numbers, not the S&P 500, which has most of its companies are huge and have the majority of their business all around the world. And so the fact that it made its all-time high back in that was what, like August of 2018, not even last August, the August before, August of 2018. And even over this last rally, up until the last couple of months, it never passed up its old all-time high. And so we see that the numbers are contrasting in the official narrative. The American economy is not that strong. And even with all the quantitative easing, the stimulus, the low rates hasn't helped out the small businesses, which is more indicative of close, domestic performance and individual financial health. So again, we're hovering right about that 200-day moving average. So we'll see. Now, I want to go back to, before I go back to gold, I want to go to treasuries. So TLT, that's an ETF, and it tracks treasuries. Now, this is a great chart because it really shows the bubble in bonds right now. So it's over the exact same period of time here this is about the start of 2019 until now. Look at that move up. Compare that with the S&P 500 over the same period of time. Let's pull that up. That's the bottom of 29. That's the beginning of 2019 until now. That's the same period of time. So you can see that at the same time that there's been a huge rally in stocks, there's also been a huge rally in treasuries. And historically, that is not normal. What that shows is asset inflation. There's lots of big money that doesn't know where to go, and so it's going into assets right now. And asset inflation usually comes before price inflation of things like services and goods and products, and then way farther down the line you get wage inflation. So the first thing that this is a loose description of the Cantillon effect. The first thing that happens when you have monetary expansion is the rich get richer. The people who have assets experience an inflation of assets. And the second thing that happens is once those assets start getting sold off, then you start having price inflation. And price inflation because people start losing a little bit of faith in the currency and the money. There's been monetary debasement, goes back thousands of years. There's a long history of this happening over and over and over and over again. You have price inflation, and that's when people start favoring goods and services over holding money. And assets start getting sold off to pay off liabilities, to pay off debts. And then after that, way after that, that's when you have wage increases. A lot of times you have state control of wages. You have, might look like a universal basic income or helicopter money, or modern monetary theory steps in and plays a larger role in the decisions that are being made. Federal job guarantees or minimum wages being hiked. So there's a lot of ways that it might play out, but ultimately wages are the last thing. So that means that the average, the common person, the worker, they're the last ones to experience receiving any of that new money that was created, and it's far too late by the time they receive any of it. So let's go back to gold, because with the sell-off in gold today, it's not huge. It's a little over 0.5% right now. Who knows what'll happen right now? I want to show you what happened yesterday. This was the middle of the day yesterday. You can see gold had popped up. It was holding right around here, and then all of a sudden there was this huge sell-off, and it's kind of been just dripping down since then. And right about then, the Bank of International Settlements apparently announced that they had a big sale of gold. And what this looks like, and it's not confirmed yet. I'm just kind of picking up pieces here and there. It looks like the bullion banks are flooding the market with sales right now of gold. And if that's true, what it looks like is that they are a little bit afraid, at least a little bit afraid of the price of gold moving up higher, because as the price of gold moves up higher in any currency, it shows a lack of faith in that currency and that sovereign debt, and so delivery starts being requested more and more as the price of gold goes up. Well, most gold is stored in unallocated accounts, and that means basically I open up an account with a bullion bank and I say, hey, I want to buy gold, I want to buy physical gold with you, but it's unallocated. There's not actually a specific set of coins or bars that are, put aside and set apart in my name. I don't have like an actual claim on a physical amount of gold. It's just a claim on gold. At any point in time, at any amount of gold, I can say it's basically like they just owe me gold. And so then at some point I can request physical delivery, and whatever gold they have, they'll give it to me. I don't have a specific actual physical set of gold set aside for me. The problem with this is that it's the standard fractional reserve system, if you will, that they don't actually have all of the gold that that there are claims on. They hold a percentage of it because historically, the amount of times that everybody wants to request delivery at the same time is fairly low. Obviously, though, when that happens, when physical delivery is requested and it starts to ramp up, it will put them out of business because they don't have the gold. And so they would have to go buy it, but they are just using the money that was paid for at the time when the price was a lot lower. And so it gets them into a position where if everybody, it's the classic run on the bank. They just don't have the amount of gold that physical claims exist on. Not to mention the futures market. That's an entirely separate issue. There many times more more ounces of gold being traded in the futures market that if any futures were actually used for real hedging and real delivery instead of just speculation, there would be a run on physical gold fairly quickly as well just from that. So what this points to is that if it's true, and I haven't confirmed it yet, but it looks like that might be the case where they're flooding the market with sales of futures and sales of paper gold just to kind of keep the price a little bit lower right now. So to me, this looks like a buying opportunity. So I haven't changed any of my kind of investment outlook right now. This is just another another confirmation that what I've been telling you guys for the last 6-9 months so far is starting to unfold now. And again, I made a video a couple months ago that talked about my prediction for 2020, my predictions for 2020. You can go take a look at that video. I thought some of this stuff would start to happen closer to the end of this year, but the coronavirus looks like it might turn out to be the catalyst, the trigger that makes some of these things start to happen a little bit sooner here. So we'll see what the Federal Reserve does. There's an almost guarantee now that they're going to lower rates. That's been basically baked into the price, the expectations in the market. And so there's expectations that that's going to kind of solve some of the problems, but ultimately what we have here is a recipe that's kind of being put together for a perfect delivery of a meal of economic crisis here. So we have a shortage of supply now, right? China makes most of the stuff for most of the world, and everybody else gets most of their stuff from China. And so we have a choking off of supply. Now, with anything, supply and demand, price is determined, but when supply goes down or demand goes up, all else being equal, price is going to go up, right? And so we're having a global supply shortage right now. And so that's part of what has triggered this sell-off in the market. That's a huge reason that, a huge thing that has triggered this sell-off. And so we're going to probably see very soon here prices start to skyrocket. So my outlook hasn't changed. Be short on cash. Don't have a lot of savings. Just store it up in your bank account. It's not going to do you any good. If you want physical cash, if you want US dollars, take it out in physical cash, because if worse comes to worse and we actually do have a huge outbreak in the States, you're not going to have access to go to the ATMs and go to the bank and withdraw a bunch of cash. You're going to want that on hand. But again, only a couple $1,000s. Don't do it with any more than that. For the bulk of any money that is your savings, allocate that to precious metals. You want your precious metals because those are inflationary hedges. Those are going to go up as money is being printed. There's going to be a shift here as more and more money is favoring holding actual commodities, physical goods and services, precious metals, real things, tangible physical assets, real estate over holding things like dollars. And then anything that's experienced a big bubble recently, we're probably going to have a shock in, like the US stock market, like treasuries. So my outlook hasn't changed. I'm still looking at everything the same as I have been for the last 6 to 9 months. The only thing that has shifted is the entrance of this coronavirus being the catalyst here, which if it takes off, this is a side note, it really looks more and more likely like Bernie Sanders will be able to win an election against Donald Trump, because when you have, Donald Trump has built his presidency on the S&P 500. That's basically all that matters right now. And if that starts to tank, well, then that's going to show that, there's a crisis. We need a change in regime. We need a different leader to handle things better. People are going to start blaming capitalism and free markets for the pain, because he's taken full credit. He's basically said that, the free markets and deregulation has been what's, smaller government draining the swamp. None of that has actually happened, but he's using that rhetoric. And so when everything turns bad, they're going to have a perfect opportunity to blame that for all the pain. And especially if something like the coronavirus sweeps through, people are having a hard time paying for medical bills, something like socialized medicine and universal health care. That's going to be a huge campaign win for somebody like Bernie Sanders, who's going to say, hey, this is how we're going to handle this type of crisis. So we'll see how things unfold. At the very least, it's going to be exciting. Make sure you keep your investments diversified with low correlated assets. If you own every company in the S&P 500, you're not diversified because they all have the exact same performance. You have a highly correlated basket of stocks. That's not real diversification. So real diversification, you need low correlation. If one goes up, the other goes down. If one goes down, the other goes up. So if you want to keep safe, make sure that your assets have low correlation to each other. If you check out the pictures of what is coming out of some of the other countries recently that have been hit hard by the virus, like Italy, in Milan, South Korea, Iran, make sure you're stocking up on supplies to last at least a couple of weeks, just in case you can't get to the grocery store, just in case a quarantine comes to a city near you, just in case your utilities shut off for a while. You want to be prepared. Don't store up on things that you're never going to need if this thing doesn't pan out. What they always say, store what you eat what you store. That way there's no financial risk. You're just basically stocking up on what you already would have been buying anyway. And so make sure you're just being smart, be prepared. And I hope this little market update helped. Let me know if you have any questions in the comments section below. Stay tuned, and thanks for watching. You guys have a great day.